Hello, Koshi here. Before we get into this episode of The Call, I've got a favour to ask. The bigger the AusBiz audience, the more we can invest in great content and keep providing quality investment ideas to you for free. If you could just take a minute of your time to leave a review of The Call in the Apple Podcast app, it'll help keep our tribe growing. And of course, don't forget to catch up with all the best interviews each day at ausbiz.com.au. Thanks for listening. Enjoy the call. Hello, welcome back to Australia's only live streaming business and markets channel. Great to have your company on this Monday as we kick off the afternoon with The Call 60 Minutes, where we analyse 10 stocks that you've sent in for adjudication. I put them to an expert panel, and it's fast and furious, a lot of information to get through, particularly today with earnings season, and a lot of specific questions that you've sent in about specific stocks, which is always great. Let's welcome our panel for today, David Novak from Wealthwise Education. David, welcome, happy Monday to you. And also Gaurav Sodhi from Intelligent Investor. Gaurav, last week of earnings? Are you surviving the earnings period so far? What's your read on it?
It's been pretty good, actually, David, especially considering, the extent of the lockdowns here. I think we maybe expected a few more negative surprises and haven't got them. Most businesses are reporting really well, and as expected, few businesses are willing to give guidance, but I don't think that's surprising or necessarily a negative. So far, so.
David Novak, the amount of money that's being hosed at shareholders, has that surprised? We've got buybacks, we've got special dividends, we've got everything coming.
Well, that shows you they've got nowhere else to invest it. So best thing is either do the share buyback or give it back to investors. The special div that was, as we saw last week with the likes of BHP. But wow, what a wild week that was, that's for sure, in the resource sector, especially iron ore.
Yep, absolutely. All right, let's kick off with stock of the day. Is something that I picked. Decided to have a look at Audinate today, the company reporting full year net loss of $3.4 million, though better than the over $4 million a year loss earlier. Revenue driving part of the recovery, up over 10% on the year to $33.4 million, though no final dividend declared. Looking ahead, the company says it's navigated successfully a challenging operating environment and continues to take a long-term perspective on running and growing the business to deliver shareholder value. Audinate, of course, is the sound platform that connects video with sound, and with its Dante protocol basically dominates the world as it continues to grow. Gaurav, what did you think of the result and Audinate at these levels?
Audinate, of course, Koshi, is one of our favourites. I've owned it personally for a long time. Our funds have owned it for a long time, and we don't spend a lot of time on the results. I just don't think the financial metrics are all that, they don't tell you all that much for the moment. There are operating metrics that are really important, and those are the number of devices that are going into AV products, the number of professionals getting trained on AV products, and the lead that Audinate has over all of its competitors. And those metrics are just getting better and better. When we first bought Audinate, it had about 6 times as many products as its nearest competitor. It now has 19 times as many products as its nearest competitor. And wow. I don't even call the rest of the industry competitors anymore. They're just other firms that happen to be there. They don't realistically compete with Audinate. And you're seeing more professionals jumping on the platform, actually getting trained up. And once that happens, it's a much better lock on the future of this platform, which does kind of get refreshed every AV cycle. So there is a natural point in which new competitors could potentially break in, but with the lead that they have and with the number of individuals now getting trained on it, I just think this is unassailable. Forget about the revenue for now, forget about the profit for now. They have enough cash flow to fund themselves, and the product is just taking off. So I'm pretty happy with the way this investment's going, and I think it's going to be much bigger in the years ahead.
Okay, all right. So still like it at these levels. David, what do you think?
Yeah, look, just from what Guru said, looks like they've done quite well considering the conditions, the COVID challenges they've had, the company, and the expansion of their products. So, they've got a global presence, and they're quite optimistic about their outlook, and the trend is up. So, to me, it's a hold. The valuation is a little bit, up there, but if you ignore that, then you'd certainly hold it. If I wanted to buy it, I'd like to buy it on any pullback rather than up here at the moment.
Okay, all right. Now, bonus stock of the day, if you like, and I love the way how viewers are targeting panelists on the call directly, because on last Thursday, we are on the call with Gentrack. And the two panelists then didn't know a whole lot about it, and sort of gave a cursory look at the numbers and the like. Aaron, one of our viewers, came back to us and said, okay, let's, Gaurav, an intelligent investor, knows this stock well. The panelists last Thursday didn't talk about the changes to substantial shareholdings in Gentrack with insiders getting involved. Can you ask Gaurav for his opinion? So one out of the blue, Gaurav, an update on Gentrack and what you think of it?
Yeah, so we have owned Gentrack in our portfolios for about a year or so, and it's been a buy recommendation for us. It's a fallen angel, if you like. Gentrack is a software provider that makes software for revenue collection. So it's mostly used in utilities, power and water providers, and it's an international product.
So when we pay our water and electricity bills, it's often then collecting on behalf of the utilities.
That's right, David. And it's actually quite a difficult task when you think about it, because you have different rates for different volumes. You have different offers and different products. Electricity provider might have different tariffs for gas, for electricity, for solar, and at different times of the day. So it's actually quite a difficult product. And the installation period is a long one, which is really great for the business because it means customers tend to be very sticky. If, as a business, the one thing you must do as a necessity is to collect revenue reliably and consistently. And so the software you use to do that in a complex industry like utilities is really important. So as the company collects more customers, you can almost call those customers an annuity stream because they leave so rarely. The churn rates are tiny, except that is when the customers go broke. And Gentrack went through a period a few years ago where it collected a lot of customers during the deregulation of the UK's water industry, and a lot of those small water businesses, which are challenges to the incumbents, they actually went bust. And so Gentrack lost a whole lot of new customers, and it went through a very difficult period. We were watching the stock through all that period and picked it up once Gentrack made some management changes. I think the management that's in there now is much better than previous management. We weren't quite happy with the way they reacted to difficulties, but I quite like the current mob who are in there. It's worthwhile noting that they've also got a big chunk of their business makes software for airports. 115 airports around the world use Gentrack software to show when planes are coming and monitor movements of airliners. And that is basically earning not much revenue at the moment. Right. So the aggregate number doesn't look very good, but when you split it up into those two components, there's a huge improvement in the utilities business, and there's no reason to think that the airports business would not pick up again once conditions allow.
And
so I still think
Aaron was asking, what's the significance? Is it NAOS, the investment fund manager, who's been buying recently and now has a 17% stake?
Aaron, look, I would say I wouldn't be watching who's buying or selling. Your opinion is more important than the opinion of others in this game. Your money's on the line, so make your own decisions. I don't know who's been buying or selling. It's not something I pay attention to unless it's an insider or someone I know.
Right.
And so I would say that's a piece of information you don't really need to worry about.
Okay.
Focus on the business.
All right, Aaron, there you go. We've gone to the guru on Gentrack. Appreciate the follow-up. Let's just start getting into the stocks you've asked us to have a look at. And David, first off, the track is Austal, the big shipbuilding company. Used to be only based in Perth, now has shipbuilding yards right around the world, including the US, as it does lots of defence contracts over there.
Yeah, look, they're reporting tomorrow. Apparently, their full-year results. So it'll be interesting to have a look at and see what that is. But their guidance back in June, if I was just looking before, it's they were saying it's a EBIT of around 110 million, I think it was 112 actually to 118 million. So it's not overly expensive in terms of multiples, earnings multiples. But they've had their COVID-related supply issues that they've been dealing with and challenges. But there's one thing that I read here about there's a civil penalty proceeding against them by ASIC. So something, to be anything like that, I would avoid for the moment until that gets resolved, settled. They did have some other proceedings, but they've resolved that with ASIC. But there's this civil penalty proceeding that's still going on. But the other thing that's positive about it is the trend has turned back up here. So you can see it's been pretty ordinary, the trend of the stock. And one positive is it's now indicating that the trend is moving up now. So it's positive from that perspective. But I'd wait to see what the results tomorrow, what their outlook statement is, and particularly what eventuates with these civil proceedings that ASIC has brought against the company.
Okay.
So at the moment, it's if you've got it, you'd hold it, but I'd wait for those results tomorrow.
All right. Joe says, Gaurav, who wants a view on Austal, I've been holding for 6 months. It's now just back into the green. What do you think of it long term?
So Joe, forget about your buy price. It's completely irrelevant. The stock doesn't care what you paid for it. Let's just focus on the value today and the price today. So Austal is a business that's worth keeping an eye on because it has a genuine global specialty. It is probably the global leader in making aluminium hulled boats. And it does so mostly for very large contracts. So governments use them for ferries, defense departments use them for specific warships. It's done this for a long time. I think the management's actually really good, but it's a difficult business because the revenues tend to be very lumpy. And for the last 10 years or so, they've had an enormous Department of Defense in the US boat building contracts known as the Littoral Combat Ship, the LCS. Now that entire program finishes up in 2024, and on our numbers, it looks like the business actually makes about 60% or so of its earnings from that one program, and that's going to wind down in a few years. So forget about the cheap multiples. There's a very good reason this stock is on a cheap multiple. It quite desperately needs to fill that earnings hole. Because earnings are about to fall off a cliff in the next few years. And that's a very dangerous time for a business. There's a temptation for management, especially in this sort of industry where they rely on long-term contracts written at cost. They have to give the DoD a cost and have that working through the system for years and years. There's a temptation to write contracts to get revenue and profits up in the short term. Now, this is actually a well-managed business. I don't think management would do that here, but you want to avoid businesses where that incentive exists and be aware that revenue is going to fall off a cliff. To the business's credit, what they've been trying to do is actually increase the services part of the company. So as they build a ship, they end up with a large fleet of vessels around the world that require maintenance and servicing. Oh. And they've actually doubled the services revenue over the last 5 or 6 years, and they aim to get it up from it's about 15% now. They want to get up about 25%.
So it's like a car dealer that gives you a good deal when you buy the car new, because they know you're going to bring it back for a service, and that's where they make the margin.
I love the idea of this giant defense business calling themselves a car dealer. I don't think they do it themselves, but it's accurate, yes.
Right, okay, all right.
So it's a good strategy. I think it's a heavily reliant on new contract wins. So it's a hold for me from here, but keep an eye on it with a few more contracts. This is actually not a terrible business. It's way better, I might add, than electro-optic systems, which I got really cranky at last week for not generating cash flow. These guys actually convert about 90% of all their profits into cash flow, and it shows you how a business in this industry ought to be run. So this is far superior. Keep an eye on it, hold.
All right. Okay, Maggie Gorab wants a view on A2 Milk. She's in it at the moment. Should she keep holding on to it? Share price has had a bit of a jump in August, particularly since the Financial Review was saying Nestle, the food giant, was maybe interested in taking it over. That's nothing has been confirmed. It's purely rumours. But share price is up 11%. But over the last 6 months, it's down 38%, and 12 months dropped 65%. It was a darling on the market until the China trade wars.
Yeah, and I think there's actually more going on here than just those trade wars. I think the consensus has the problem identified as being one of a broken channel. You know, that the Daigous, the foreign buyers coming to Australia and taking product overseas, are no longer able to do so. And that's what's keeping revenues down. And that might be true, but from the research that we've kind of been doing, it looks as though the market in China has changed, and perhaps permanently changed. Ever since COVID probably helped this transition, but I think it would have happened without that anyway. Local brands in China are getting far more love from local customers in China than foreign brands. The last decade and a half or so has really been a story of foreign brands attracting a big premium, and those brands being the ones that everyone wanted to purchase in a whole host of industries, particularly infant formula. And I think that's reversing now. There's a whole bunch of new competitors in China gaining a lot of market share. The premiums that these brands could command, and A2 was selling, tins of baby formula for $90 a tin, which is extraordinary. Those kind of sales are long gone. So I actually think the business model here might be broken. The brand may not be as valuable in China as it used to be. There's a very good business here in traditional milk, and I think the American milk rollout is super interesting. But this is, 70% of the profits are in unsustainably high milk infant formula margins, and I don't think those margins are returning. I think there's a takeover potential here. So if you want to hang around for the takeover, you can hold it. But I'd be selling and staying away.
David?
Yeah, look, very much the same view. It's a speculative buy for the takeover. It's touted that Nestle may make the bid. But, look, the biggest risk here is the agreements that they have in place with their suppliers, and the concern is they may be forced to commit to the, forward inventory orders despite the current lull they've got into Chinese demand. So that's one of the biggest risks, as was just highlighted. And so that would create excess supply.
Yep.
And reduce margin. So yeah, it's an avoid for me, but only if you want to have a speculative play on it for that takeover potential.
Okay. All right, David. Scott wants a view on Codan, saying keen for the panel's view following their results and the departure of the chief executive. Should you hold off investing until a new CEO is announced? Extremely solid track record over the past 4 years of growing sales, EPS and free cash flow. Codan, of course, is in the metal detection business and also a smaller division in communications. I remember sitting next to the Codan chairman at the football a couple of months ago. He was telling me these amazing stories of African villages. When the gold price goes through the roof, they all club together and buy their own metal detector for the village and go out hunting gold. So it's a funny business, but has delivered.
Yeah, look, their numbers are good. If you focus on their growth, their earnings growth has been great. And as you just pointed out, it's mostly been in the metal detectors, which represents 75% of their total revenue. They had, the increased revenue for the financial year was up 26% on the corresponding period. But again, as you pointed out there, Koshi, that is that if there's the with the demand of gold, if the gold price goes up, they'll probably increase the demand for their metal detectors. But also, their other side of the communication side of the business is 22% of their revenue, but they reported a drop of 8% actually in the last year. The trend at the moment is just turned down. So for that reason alone, it would be technically not a buy right at the moment. But I do like the company. And I would wait for signs that the trend was turning back up here. But again, depending on what happens with the gold price as well. But their earnings have been great. It's it's strong.
Gaurav?
This is I love that story, by the way, Koshi. We heard that as well from the chairman. Exactly the same story about the African villages banding together, and it looks as though that's exactly what happens when the gold price goes up. And it really shows you that there's so much cyclicality at play in this company. The sales are so dependent on high gold prices, and that's why over the last 4 years or 5 years, revenue and profit increases have kind of mimicked rises in the gold price. And I think what it does is it makes a cyclical business look like a growth business. And it's trading at 30 times earnings, and you break down these growth numbers. As you say, they've got a little communications business in there, and that makes 15, $16 million a year. That's flat. That's not growing. All the growth in the earnings have come from the metal detection business, which has grown from 30 million in profit to $140 million in profit. Wow. Margins have doubled in that period. I think what you're seeing here is a cyclical high. And the market's treating it as a conventional growth stock. This is one of the most dangerous situations to get involved with, where you've got artificially high margins, artificially high profits, and a PE ratio that's expanded hugely. It's a sell for me.
Okay. All right. Shabir, Gaurav wants a view on Nanosonics. Shabir says, currently down 60% from the January high. Company's busy researching and developing a number of new products which are due to be launched in the coming years. One's just been revealed, Auto Audit Pro. Is it a long-term buy? Now it's sort of main business, isn't it, is this Trophon disinfectant sort of technology for surgery implements in hospitals, and everyone has criticised it in the past, saying it's a one-trick pony. And now they've launched this digital platform which traces infections and control measures, does that?
Yeah, so this is actually a very difficult business to value. The numbers look just crazy. This is a $1.7 billion business. I think it's like 20 times revenue for a device maker. It's extreme. It's one of the most expensive stocks in the industry. But I think you got to look a bit deeper than that, because when you break down the revenue model, the way Nanosonics accounts for his revenue is both unusual and distracting. In some sales that it makes upfront. So it sells a Trophon unit upfront, which is very expensive. It recognizes that revenue, and that's the sale done and dusted. Other sales it makes are actually on lease terms. So you get a small upfront component, and then you have a long trail of sort of recurring revenues, and so the combination of all those different and there are several other revenue models, I might add. So a combination of all those different revenue models makes earnings quite difficult to measure. We know that the product is fantastic. It's probably the standard now, and if it's not, it's about in about a third of American hospitals. And that's growing quite rapidly as well. And once you've got the equipment in there, the consumables, which are the really high margin stuff, the blades to the razor, they actually just keep on rolling through, and they just they generate years of profitability. It's a wonderful business model. I'm just a bit cautious about the valuation up here. Everyone is aware it's a wonderful business model. I think there's a sense that the new product has disappointed a little bit. I think the market was expecting a little bit more. That may be an opening. I would say hold for now and keep an eye on it at lower prices. This is certainly a business you want to own at some stage. So hold for now.
Okay, David?
Yeah, look, I agree with the comments there about the valuation up here. It's you wouldn't touch it if you just looked at that, but it's such an important segment of the business the company provides, a really important service and hardware, I should say. But also, they've recently launched this new software as a service product called Audit Pro, and that's going to be what they call Halo's second product. So the market's anticipating that it should incrementally add to the overall share price sentiment in the future, but they don't anticipate any material impact for the next year or so. But that's at least they're they've got this diversity. They're offering this service. So it's for me. I'd go along the same lines as a hold, but I wouldn't be buying it at this stage. And the valuation just looks a little bit stretched. And it's quite interesting. There's about 9 brokers, I think, out there. So it's got some pretty wide coverage in the brokers. And their valuation as a average mean price is around 10% below where the price is trading at the moment.
Right. Okay. All right. David, Matilda wants a view on Beacon Lighting, the big lighting retailer that's ridden the lockdown boom as we all upgrade our lights to work remotely, change the aesthetics as we're sick of them sitting at home. What do you reckon of Beacon?
Yeah, the company's had some really good numbers here, and it pays a good dividend yield as well. So it's got a nice trend. The retail sector generally. I mean, obviously they're doing quite well while everybody's in lockdown. So the trend is your friend at the moment. So this is a hold or even a buy for me up here. It's not overvalued. It's multiple of about 11 times last time I looked. So good dividend yield around 4.5%, fully franked. So it's not overly priced and good earnings growth. So it ticks a lot of boxes, and they've got a positive outlook going forward. So it's the trend, everything, it ticks a lot of boxes for me. So I like Beacon Lighting, and the return on equity is very high. It's around 38%. So really strong earnings growth here. So it's got some momentum. Yep. And so it's a buy.
Okay, buy. Gaurav?
Yeah, Beacon. When we talk about really high quality retailers, it's not a name that pops up often. That list is often populated by names like Lovisa, Premier, Accent Group, and Supercheap. There's a bunch of others, but Beacon is not one that typically sits on that list, and perhaps it should. This is actually a pretty decent business. So the margins, the gross margins here are almost 70%, which is extraordinarily high for a retailer. And they're high because the company works on an unusual business model where it actually integrates its supply as well. So it designs and owns a lot of its own supply chain. So it's a similar business to Lovisa in that way. And the inventory turn isn't quite as good. So it doesn't sell as much stock. It doesn't turn over as much inventory as I'd like, but it's pretty good for the kind of products that it sells. There's only 115 stores here, and the company reckons there's room for about 180 or so. Absolutely cracking result. About 10% of the sales are online, and there's really good channels here for commercial and trade sales, and they've got a little bit of international sales as well. What was really interesting about this, which I didn't realize before, was that they've actually purchased property. They spent $15 million last year just buying up large format retail centers. A couple of those centers have Beacon stores in them, but some of them don't. And that's an interesting play. That's unusual, a big change from the traditional retailing strategy. I would like to hear a bit more from management about the plans for retail. It's unusual for a retail business to spend scarce capital buying its own property. So the owner here owns about 50%. The founder owns about 50% of the stock. So it's probably not a waste of money, but that's something I would investigate before buying the stock. What exactly is the strategy here for this burgeoning property portfolio? But otherwise, look, this is actually a pretty good business and very undemanding on price. I think it gets overlooked a little bit. I'm going to put a little buy on it, but with the proviso that you want to go off and maybe just learn a bit more about that property investment.
Because Harvey Norman is mainly property too, isn't it? It's the model where you own the store as well, and it's a big property play. Are they trying to follow that?
Yeah, well, they franchise some stores and own others, so it could be that they're trying to turn themselves into a Harvey Norman model, which is a superior business model, to be sure. Yeah. So if that's the go, then I think that's great. But if this is the other thing I was thinking was, we've got these new accounting measures that treat rent as debt, and
right.
If this is a way to get through covenants or to make the books look a bit better, then that's something I'd be wary of.
Yeah.
So I really want to hear what management has to say about that investment. And if it is a Harvey Norman style play, that's a very significant change in direction. So we probably need to hear about that.
Okay. All right. For those who don't know, the accounting standards changed in the last year or two, where a lease forms now is sort of classified as debt on your balance sheet. Let's just recap the first five stock of the day. Ordinate, a hold from David. Gaurav still likes it. It's one of his favourite stocks and has a rosy future. Austell, a hold from both. Big ship maker, but it's reporting tomorrow, so look out for that to see what happens. A2 Milk, only if you're going to take a speculative punt on maybe somebody's going to take it over, as has been sort of rumoured in the Financial Review recently. Otherwise, it's a no from David and actually a sell from Gaurav. Codan, a no from both. Nanosonics, a hold from both. And Beacon Lighting, a buy from both, with Gaurav on the proviso. You do a bit more work on, a bit more explanation from the company on why it's buying property now. Here at the call, we've been following our own fantasy portfolio since the 1st of July last year, thanks to our partner NAB Trade. Any stocks that get 2 thumbs up, like Beacon Lighting has just got, goes into the calls portfolio. Let's see how it's been going. For the week, down 1.75%. For the month, down up 0.7%. And since the 1st of last month, the 1st of July this financial year, up 1.9%. For last financial year, was up about 35%. Some of the stocks recently added: Macquarie Telecom, MSL Solutions, Magnus Energy Technologies, Telstra and Raise. Some of the stocks removed: Jadison Education, Virgin Money, Link Administration, the Asia Technologies Tigers ETF. You can check out all the stocks and ETFs in the calls portfolio. Head to ausbiz.co/portfolio. And quick reminder from us here at Ausbiz, if you know someone who's interested in investing but may not be aware of us, now's the time to let them know. If you refer 5 friends and they sign up to Ausbiz, you'll go into the draw to win one of 6 prizes in a pool worth $10,000, including a $5,000 self-wealth trading account and some premium wines from Nepenthe. To enter, use the referral code in your CIB newsletter that you get each evening, and share with your networks. Still plenty of time to subscribe to Ausbiz. You can do so by signing up at ausbiz.co/join and get your entries in quick. It finishes on the 5th of September. All right, let's get into our next 5 stocks. Interesting one now from Jeremy on BCI Minerals. Jeremy says, can you take a look at a small interesting stock called BCI? What's the outlook like? It's a salt and potash miner/developer. Recently resulted pretty good earnings, revenue up 108%, EBITDA up 248%, big increase in net profit. And Gaurav, potash, has sort of come into focus since BHP sold out of oil and gas and has now bought into potash.
It has, yep. Potash is interesting because it is a global cartel run by a handful of producers who control the price pretty tightly. So if you're an external producer who can break into that cartel and not have to abide by its volume and price rules, then you can actually make a lot of money out of potash. And I think that's what BHP ultimately aims to do. It resembles iron ore in that you're moving a lot of low value material around. So I mean, you can just see from BHP's own numbers, they're spending about $7 billion on building infrastructure to move before they generate $1 of revenue. It's a big boys game, potash. This is not one for little companies. And BCI is not really a potash producer. It's got a potash project. It's a salt project with potash bycredits, but it owns an iron ore royalty, which is why the results look so spectacular, because we all know what's happened to iron ore prices.
Yep.
Now, it's worth noting that iron ore has fallen 40% over the last week or so. I think those prices are coming way down, and we're on record as saying that they should be $60 to $70, nowhere near the 150 or whatever they are now. So once those prices come back to normal, I'm not sure that the royalty looks all that attractive. This is nowhere near the quality of Deterra's iron ore royalty. That is an outstanding asset. This is an okay one. So the idea here is for BCI to use cash from the royalty, some debt and some equity to raise the $1.2 billion it needs to go off and fund the salt and potash project. Now, I don't know anything about the economics of salt. In 10 years as working as a resources analyst, I've never looked at a salt mine anywhere in the world, so I don't know how those economics work. But I don't fancy the chances of a $200 million business raising $1.2 billion in funding. It probably requires about $500 million in equity and the rest in debt. I just don't think it's going to happen. This is this looks great on numbers. It's got a lot of cash on balance sheet. Looks very cheap on operating on financial metrics, but I think it's a mirage sell.
Okay. David?
Well, I'm going to totally disagree with all of that, because this is the stock that I recommended in early July. That was, if you want a life-changing stock, this was the one. So I know quite a bit about it.
Yep.
So first of all, if you look at the metrics, the economic metrics of the Marty Salt high purity salt and potash project, which is scheduled to commence late 2023, and the potash project in early 2024. Now, if you look at the, let's say, the definitive feasibility study, they've had all the approvals ticked off with the Environmental Commission in Western Australia. They're just waiting for the final tick off on the Western Australian ministerial approval. But they've already got a $450 million approved loan from the federal government called the Northern Territory Loan of $450 million over 15 years. That's already been approved for this project. As at the end of July, they had $110 million in the bank. Again, their revenues, their sole revenues right now is coming from that royalty, from the Iron Valley royalty from mineral resources, which is about 6 million tons. Now, it's interesting, people have all different forecasts about the iron ore price. None of them get it right, of course, and nobody's got a crystal ball. According to my charts, and I've been watching charts for more than 30, 40 years, is that, yeah, this expected pullback, but you've got to remember the Aussie dollar is back to about 71 cents. So even though right now iron ore is about 150 US, there's still a huge margin in these producers. So, getting back below $60, $70, I mean, that's a long way to go before it gets there. I'm not so pessimistic on the iron ore price. And also with the passing of the infrastructure bill in the US, you'll find that they'll obviously have a high demand for steel. So I'm still positive on the outlook for iron ore. I think there's a real opportunity, but that's not the reason I like BCI Minerals. I like it because they've got $110 million in the bank. They've got that approved loan already. The net present value, if you look at their last PDF, you'll see that the net present value of this project right now is almost 1.7 billion. This is a tier 1 project that goes for 60 to 100 years. they'll be generating an EBIT of $260 million every year.
Right.
For a market cap of 260, it's outstanding. So right now you wouldn't buy it because the trend has turned down short term because of the iron ore price, but geez, keep this one on your watch list.
Okay. All right. Thank you for that. Our next stock is Tabcorp, and our viewer has Igor says Gaurav would love this one. Gaurav, you've been targeted by Igor. Tabcorp, the big wagering business. What do you think of it?
Igor's right. We bought this during the March drawdown. Had my eye on it for a long time. Tabcorp. It's was one of the worst managed businesses in Australia. I've said it's right up there with NAB, AMP, and Tabcorp is the trifecta of awfully managed businesses. But the difference is that Tabcorp is really two businesses. It's a wagering business, but there's also a lottery business in there. And we've been looking at that lottery business for several years and identified it as maybe the best quality business in Australia. That's a full stop behind that sentence. Maybe the best quality business in Australia. I think it's worth perhaps the entire Tabcorp market cap as it sits today. Wow. You just saw a private equity firm take over Telstra's tower business at sort of 28 times EBITDA for a non-controlling stake. If this thing when this thing gets listed, I think it's going to be extremely valuable. And if it's not valuable on public markets, a superannuation fund or a sovereign fund will buy it because it's a wonderful asset. And in fact, the wagering business is actually slowly improving and getting better as well. And I love that there's new management and new board members there as well. And so this has gone up a long way since we've been talking about it, but I still think it's a buy, and I can't see a valuation less than $7 on Tabcorp. It's still a buy.
All right, David.
Look, I agree with all of that. I think that the gaming service is obviously the one that's because of COVID is fallen behind, but there's certainly the lotteries business has picked up strongly. And online wagering, because what else are people going to do in lockdown? The only thing is with the trend at the moment, it's turned down. So for that reason alone, it wouldn't be a buy for me. Although there's much higher price targets out there on the company. When you look at there's about 10 brokers, and they've got an average price target of around $5.50. So it's well below that. So it will be a buy, but technically. It's not a buy for me at the moment.
Okay. All right. Michael wants a view, David, on Seven West Media. Michael says results are in line with expectations last week, although they flagged a high cost for this financial year. Share price down 8% since the results. What does the panel think of Seven West? Are current lockdowns a drag on the share price, and is there a reopening play here as we look towards 2021? Or 2022. What do you think, David?
Look, at the numbers that they reported recently look pretty good to me, I must say. I was looking at their growth numbers here, and their revenue is up 4%, EBIT up 105% to 254 million, underlying net profit 126 million. So, they're on an earnings multiple of only about 7 times, and they're actually getting some traction here in the digital side of their business as well, and advertising. So I do like the stock up here. It's right now I'd like to see it turn up. The buy for me, again coming back to the technicals here, it's just closed below. It's just trading below its 50-day moving average. So for that reason alone, I wouldn't be buying it. But certainly if it ticked back up, and it got back up above 50 cents or thereabouts, this would be a buy for me. But I like their numbers. Their numbers are really quite impressive, and they're getting some good content as well. With the Olympics, of course. There's The Voice. It's all these the Ashes coming up, the AFL. They've got all these great programming, that going forward, and good strong revenue growth in advertising. So it actually looks really good. I would definitely be looking. It's a hold at the moment, and I'd be looking to buy it when it turns back up.
Okay, Gaurav?
David forgot to mention they apparently have some decent morning show as well, which I don't know. I've never seen it, but apparently quite good.
Which is a massive revenue driver.
Indeed. Look, I've got to say, this was a stunning result. Every result season, there's a handful of results that make you sort of look at a company in a new way, or make you rethink what you thought about a business. And this has done that for me. I was genuinely surprised. I mean, I think we all kind of expected a better result because of the Olympics and because of lockdowns. But the digital business in particular really surprised me. They are shooting the lights out with that digital business. And not only are the metrics good, but they've actually articulated a strategy to sustain very good numbers out of digital. And I think they're integrating digital and non-digital platforms really intelligently. It's not a word I've used for this industry in the past very often, but both 9 and 7, I think, have gone through something of a strategic renewal. There's some interesting ideas coming out of these companies now, and it probably deserves a rethink. So we've been very negative on this sector for a while, and it's hard to be anything other than negative when you speak to anyone under the age of 30, let alone anyone under the age of 20 who just do not watch television anymore. But these digital platforms and the way they've integrated various other content properties with these platforms, there's a plan at work here, and it is working to some extent. So I think this is interesting. I'd put a hold on it for now. Both 7 and 9. It's something I would like to go back and have a look at again, because I think what my assumptions have really not been correct about these stocks, and I want to go back and have a look at it again.
Yeah.
More interesting than I thought. Hold.
Yeah, and James Warburton, the MD, has paid down a lot of debt out of all of this, so debt's pretty well under control, which was a real knock on it in the past. Gaurav, Saul wants a view on Redbubble. Saul says, can I get an opinion on the stock after their results last week? Share price jumped up. What are the long-term prospects? Of course, Redbubble is an online marketplace for artists and craft and things like that, isn't it?
It is a really interesting product. I quite like the product itself. So what it is all these artists have designs that they launch on Redbubble, and a lot of them are sort of popular memes and popular characters driven. And you can get those designs then printed and made up into anything you can imagine: cushions, rugs, shirts, caps, masks. So Redbubble will take the design, they'll pay an artist a sum, and they'll actually take care of the entire process of printing, payment, delivery, and billing. And so it's actually quite a good service for the artist involved, and it results in quite unique content, unique products for the purchaser. The problem, it's a wonderful idea. I think the founder is still involved in the idea. The problem they've got is that the business that benefits most from Redbubble is not Redbubble, it's Google. If you look at the costs of this company, so much of the revenue just goes automatically straight to Google in AdWords, in advertising. And every time I look at this business, it just reminds me that I should be owning Google stock. And looking at the result now, it just gave me the same thought. This is an interesting business. It's not real. You can't really invest in this. I don't think it's a high quality business. I think it's nicely managed, a great product, but Google owns the value in the chain here, and not Redbubble. Okay. I would sell this and go buy Google.
Okay, David.
Yeah, look, I do like their global presence and the numbers. They're consistently being, the consistent growth here, and they're certainly, got some recurring revenue, about 42% by the looks of it as well. But look, their numbers, the latest numbers they came out with, I was quite impressed with, and they seem to be making some real traction here. So I do like it, and that's why you saw a big turnaround, sharp turnaround in the share price when they reported last week. And so on the chart itself, if you look at there's broker coverage out there. There's only about 4 brokers out there with a higher price target of about $5.70 on average, and it's well below that. So there's certainly, according to 4 brokers, they've got much higher valuation on the company. Certainly, when it was $7, there's no way I would have been interested. But down here, I've got to say, with the volume that I've been seeing here on the chart, and this spike turnaround, there's quite a sharp turnaround here. It's becoming interesting to me from a technical perspective, and you look, they are making a lot of traction here in that area, and I would be interested in it. Not to buy right now. If you've got it, I'd be holding it, but I'd be watching this. Look, this would be in my watch list. I do like it, so and they've got consistent growth. So to me, it's a hold at the moment.
All right.
Yeah.
Can I be a bit more cynical about that, David?
Sorry, go ahead.
If I can be a bit more cynical about that, I actually thought the result was quite poor, and I was surprised by the market's reaction. But the brokers probably smell a cap raising opportunity here, and I think I'd be shocked if I ever saw a broker report on a business like this that's quite capital hungry that's less than the share price, because that's not how they make money.
Yes, you are very cynical on it. That's what we love about you, which is great. David, our final stock is TPG, the telco, of course, that is sort of putting together Hutchison Vodafone. What do you think of TPG?
Yeah, look, I don't mind TPG. I think, especially with expansion of the NBN program. But look, they're just. I'm going to say about TPG. Look, they had some good numbers here, but I don't know. I'm leaning more towards Telstra, to tell you the truth, than TPG. I think Telstra's got a bigger market share here, and but look, there's brokers out there that's got much higher valuations of around $7.50 for the stock. It has been trending, moving back up here, as you can see. But look, I just think I would prefer to buy it at lower levels, to tell you the truth. And I think if I had a choice between Telstra and this one, right now I'm more favouring Telstra as a buy. This would be a hold if you've got it. It's a hold, but I wouldn't be rushing to buy it today. I'd like to just see, how their numbers and growth progress from here.
Okay. Gaurav, you've been a bit of a Telstra fan for a while. What do you think of TPG?
Yeah, we actually owned TPG until David Teo left, and the next day, in fact, that day we sold stock and slapped a sell on it. And I'm really glad we did, because this was a poor result. The mobile business is really bleeding customers. It was bleeding customers under Vodafone. It's bleeding customers now. And this is happening in an environment where Telstra, the bureaucratic elephant in the room, who is hardly the last word on innovation, is actually gaining market share, and Optus is gaining market share. So it's clear who's losing in this sector, and it's TPG Vodafone. The broadband business equally was not doing great. This has traditionally been a strength, and the numbers don't look all that appealing. Aussie Broadband, which we own and huge fans of that business, that's just wiping the floor with the industry. And the best part of TPG has always been its corporate fiber business. This is a legitimately fantastic segment. They build dark fiber that goes from corporate offices into data centers, into telecoms exchanges, and corporates can get private, secure, super fast fiber access where they need it. This is 60% margin traditionally. This year, revenue down, margin down, profit down. Really, and that part of the business is so diluted now that it doesn't really contribute to the whole. So I was unimpressed with this. I thought the tack on at the end about selling towers was just a way to get the share price up. Unimpressed with that. This is a sell.
Okay. All right. David Novak from Wealthwise Education. Great to see you, sir. Thanks for joining us. Likewise, Gaurav Sodhi from Intelligent Investor. Appreciate your time.
Thanks, guys.
My pleasure.
See you guys. All right, let's quickly run through our final 5 stocks before we've got to go. BCI Minerals, a no from Gaurav. Certainly a watch from David. Chart showing share price going in the wrong direction, but put it on your watch list for when it starts to turn around. Tabcorp, a yes from Gaurav, a no from David. Seven West Media, a hold from both. Gaurav's going back to have a look at it because the recent result has made him reassess Seven West, and David likes it as well if the chart can get up to 50 cents. If the short-term pullback in the share price, if that turns around, gets above 50, then he'd be buying it. Redbubble, a no from Gaurav, by Google instead, and a hold from David. And with TPG, a no from Gaurav. He prefers Aussie Broadband and Telstra, and a hold from David, although he prefers Telstra as well. If you've got any stocks that you'd like us to have a look at, put them in an email, thecall@ausbiz.com.au. And a reminder, you can see all the stocks in the calls portfolio, ausbiz.co/portfolio.